Welcome back to AlgoBot, the channel where we break down automated trading strategies for MetaTrader 5, one expert advisor at a time. I'm your guide here at AlgoBot, and today we are examining a pure price action system called the Engulfing Breakout Hedge. In the next few minutes, you'll learn how it maps out floor pivot levels, how it uses the engulfing candle pattern to confirm a momentum breakout, and how it deploys a protective hedge when a breakout turns out to be false. Everything here is educational analysis only, so let's open the chart and walk through how this approach is built. Let's start with the big picture. The Engulfing Breakout Hedge is a pure price action strategy. That means it does not rely on any indicators at all. There is no moving average, no relative strength index, no Bollinger Bands, and no average true range. Instead, it reads the raw candles and the structure of price itself. The foundation of the strategy is the floor pivot. Over a window of recently closed bars, the expert advisor records the highest high, the lowest low, and a reference closing price. From those three values, it calculates a central pivot point, and from that pivot it derives a resistance level, called R1, and a support level, called S1. The distance between those two levels becomes the natural measuring stick for the whole strategy, so every buffer, stop, and target scales automatically to any symbol or time frame without hard-coded pip values. Now, most range traders do the opposite of this approach. They sell at resistance and buy at support, expecting the level to hold. This strategy is the deliberate mirror of that idea. It waits for a level to actually give way, and it only acts when that break is stamped by an engulfing candle, one of the most widely studied confirmation patterns in classic price action. The signature mechanic is the hedge. The most common failure of any breakout method is the false break, where price pokes through a level, traps the breakout participants, and then snaps back. Rather than simply absorbing that, the strategy opens an opposite position to ride the snapback in the other direction. In terms of market and style, this approach is designed for liquid, level-respecting instruments such as the major foreign exchange pairs or gold on intraday timeframes from 5 minutes up to 30 minutes. Where pivot breaks and fakeouts tend to alternate throughout the session. It is best suited to a trader who is curious about structured, rule-based breakout logic and who wants to study how a system can plan for its own worst case. As always, this is educational information, not a recommendation, and trading carries real risk of loss. Let's walk through the exact logic, step by step. On every freshly closed bar, while the account is flat, the expert advisor recalculates its floor pivots from the look-back window of bars that come before the signal candle. It takes the highest high, the lowest low, and the close of the bar just before the candidate candle, and from those it builds the pivot point, the resistance level R1, and the support level S1. The range between R1 and S1 is the same as the high minus the low, and that range sizes everything that follows. Next, the strategy inspects the most recently closed candle for an engulfing pattern. For a long setup, it looks for a bullish engulfing candle. The body must be bullish, the prior candle must be bearish, and the new body must fully cover that prior body. On top of that, the candle must open at or below the resistance level R1, and it must close decisively above it by a small buffer. When all of those conditions are met, the strategy reads it as resistance breaking with momentum, and it opens a long position. The short side is the exact mirror. The strategy looks for a bearish engulfing candle that opens at or above support S1 and closes decisively below it. That is read as support breaking with momentum, and it opens a short position. Now for the protective levels. The base stop loss is placed structurally beyond what the code calls the hedge trigger, so that the hedge always engages first. The base take profit projects a reward fraction of one range in the breakout direction. With the default settings, that target sits roughly one full pivot range away. Here is the signature part. While the single base position is open, the strategy watches for the breakout to fail. If price travels a set fraction of the range back through the broken level, the break is judged false, and the expert advisor opens an opposite position. Now it holds both directions at once, a genuine locked hedge that rides the reversal and offsets the trapped base leg. Finally, the dominant exit is basket money management. While any exposure is held, the strategy sums the net floating profit across all open legs. The instant that net figure reaches the basket take profit amount, it it closes everything and banks the result. If instead the net floating loss reaches the basket stop amount, it flattens everything as a hard ceiling. This protects against the real danger after a hedge locks, which is a strong continuation of the very breakout that just failed. Remember, these are mechanics for study, and losses are a normal part of any strategy. Let's read through the actual MetaQuotes language code on screen, the way it appears in MetaEditor. At the top are the input parameters. PivotLookback, set to 20, is the number of closed bars used to build the pivots. ZoneFrac controls how near the level the candle's open must sit. BreakFrac sets how far beyond the level the candle must close to count as a break. Engulf body ratio defines how strong the engulfing body must be relative to the prior candle. HedgeFrac, StopFrac, and RewardFrac size the hedge distance, the stop pad, and the take profit, all as fractions of the range. BasketTpMoney and BasketSlMoney govern the basket exit, and lots sets the volume. Now look at the long block. The two conditions are opened at R, which checks that the candle opened at or below resistance, and closed past R, which checks that it closed decisively above resistance by the break buffer. When both are true and the bullish engulfing flag is set, the code computes a hedge trigger just below R1, places the stop a structural pad beyond that trigger, and sets the take profit 1 reward fraction above the ask price. Then it calls trade.buy with that stop loss and take profit. The short block is the exact mirror. The conditions opened at S and closed past S confirm the candle opened at or above support and closed decisively below it. With the bearish engulfing flag set, the code builds the hedge trigger above S1, places the stop beyond it, sets the take profit 1 reward fraction below the bid, and calls trade.sell. Notice how clean and symmetrical the two sides are, which is exactly what you want in a rule-based study. Let's bring the logic to life on this illustrative chart. The two dashed horizontal lines are the floor pivots that the strategy calculates. The upper red line is the resistance pivot R1, drawn here at 1.0865, and the lower green line is the support pivot S1, drawn at 1.0845. The space between them is the range that sizes everything the strategy does. Look at the first few candles on the left. Price is drifting sideways inside the range, brushing against resistance, and then easing back toward support. This is exactly the kind of indecisive, level-respecting behavior the strategy is built to wait through. Notice that just before our entry, there is a small bearish candle that pulls back from resistance. That candle matters because it becomes the reference for the engulfing pattern. Now watch the fifth candle. It opens down near the prior candle's close, sitting at or below the resistance pivot, and then it pushes strongly higher, completely covering the previous bearish body. This is a bullish engulfing candle, and it closes decisively above the resistance line at 1.0865. Both conditions from the code are satisfied. The candle opened around the level, and it closed beyond it by the break buffer. That is the long entry. You can see the buy entry marker right at that breakout. The strategy reads this as resistance giving way with momentum, so it goes with the move. From there, follow the next two candles upward. Price extends in the breakout direction, candle after candle, with each one building on the last. The take profit was projected roughly one full range above the entry, and you can see price reach the take profit marker on the seventh candle. The long position closes there, banking the move while momentum is still strong. That is a clean, textbook breakout play, going with the level break rather than fading it. Now the market changes character. After that peak, price rolls over and begins sliding back down through the range, heading toward the support pivot. Watch the small bullish candle that forms as price approaches support. Just like before, it becomes the reference candle for the mirror image pattern. The very next candle, the 11th on our chart, opens at or above the support line and then drops hard, engulfing that prior bullish body and closing decisively below support at 1.0845. This is a bearish engulfing candle, and it satisfies the short conditions in the code. The candle opened around the support level and closed beyond it. That is the short entry, marked by the sell entry marker. The strategy reads support breaking with momentum and positions in the direction of the break. Follow the final two candles down. Price continues lower, extending the breakdown, and reaches the take profit target roughly one range below the entry. You can see the second take-profit marker on the last candle, where the short position closes. So across this single illustration, you have seen both halves of the strategy. A bullish engulfing candle broke resistance and led to a long that ran to its target, and a bearish engulfing candle broke support and led to a short that ran to its target. And remember, in live conditions, many breakouts fail. That is precisely why the strategy keeps the reversal hedge and the basket exit in reserve. This walkthrough is a simplified, educational illustration, and real markets will not always behave this cleanly. And that brings us to the end of our look at the engulfing breakout hedge. Today we covered how the strategy builds its floor pivots, how it uses bullish and bearish engulfing candles to confirm momentum breakouts of resistance and support, how it sets its stops and targets from the pivot range, and how it manages risk with a reversal hedge and a basket exit. Everything in this video is educational information only. It is not financial advice, not a recommendation, and not a solicitation to trade. If you found this breakdown helpful, please like the video, leave a comment with the strategy you'd like us to analyze next, and subscribe so you don't miss future episodes. You can find more strategy studies over at www.algobot.live. Past performance does not guarantee future results. Trade responsibly.